All right, so it is 1 p.m., so we're going to go ahead and get started today. I want to say welcome and thank you for joining us. I am Hallie from Alive Credit Union, and today we're presenting Home for the Holidays, Your Path to Home Ownership. And what's really exciting about this is we're going to be able to go through all of the basics that you need to know prior to applying for a mortgage so that you're ready and prepared. And I do have an esteemed colleague and mortgage expert here on the call with me, Ken. Ken, do you mind just saying hi to everybody and a really brief introduction?
Thanks for joining us. We really appreciate it. Glad to have you here today.
All right. And if you have any questions throughout the presentation, just as quick housekeeping, you can go ahead and enter in that question into the chat. As we can, we will answer those. But we're going to try to keep it moving because I want to be mindful of everybody's time. If you are not able to stay for the full presentation today, or you want to share with friends and family, it will be available as a replay on our YouTube channel, probably in about 24 to 48 hours. So let's get started. So if you have not heard of Alive Credit Union before, we are a not-for-profit financial institution based out of Jacksonville, Florida, here in the U.S. Our mission is to inspire financial wellness, which is why we provide free events such as this one. And like I said, we did have Ken Gallagher join us today because he's a mortgage expert. My name is Hallie, and I am a certified financial counselor here at Alive and our community development representative. This presentation today was actually put together by our partner, Member First Mortgage. They are a credit union-based service organization that is out of Rapid Falls, Michigan, who services over 40 states in the country and over 200 credit unions. So this should be a really knowledgeable presentation for you guys to reference. So first question, over in the chat, if you want to put what you think, how many of you think that you have to have 20% down, ready to go, cash down in order to buy a house? I'll go over and check the chat. And I'll go ahead and I'm going to let Ken take this. Ken, can you tell us, is it true or false? Do you have to have 20% down in order to buy a house?
False. So false nowadays. Yeah. That's an old school way of lending. And there's still great loans for people who have that out there, but and you are rewarded for it nowadays for having 20% down, but it's definitely not what you have to buy a home.
And it looks like our guest already knew that. Beverly and Christy, thank you so much for participating. Ooh, my lights went out. All right. So how do we know if we're ready to apply? All we really need is to know our credit history and score. We're going to need an understanding of loan to value and debt to income, which we're going to go into, and what money is actually needed. So when I say you need to have a credit history and a credit score, what I'm saying is you need to understand what's on that report and kind of have your ducks in a row. So a credit history that they're going to look at when you apply for a mortgage is going to be detailed information from your credit report. It's going to show how we as consumers use and manage our credit in the past and in the present. Minimum scores, a lot of people call and they ask, what score do I need to apply for a mortgage? That's going to vary depending on what kind of mortgage program you're going into. But it's always best practice to just make sure you have your credit right, know what's on there, and keep your payments up to date. You also want to be aware that two factors that are going to contribute to being able to get a mortgage are going to be your loan to value ratio and your debt to income. Loan to value is just going to be the number that's determined on how much is in the house according to, so let me slow down here. It's just a value ratio that's going to be the loan amount by the home's value, and that's going to give a percentage. And your mortgage rep, like Ken, is going to look at that percentage and say, you know what, maybe this house is a little bit too much. So just because the loan to value isn't right, don't feel discouraged. You might just need to keep shopping for a home. Debt to income is also a ratio you're going to want to be aware of. That's simple. That's just how much debt you have versus how much income you have to pay your bills. And then you want to be aware of what money is needed. So there is a down payment sometimes, not with a VA loan, I don't believe, right, Ken?
Correct. VA and a couple of other loans, USDA, some offer 100% financing. And then there's other programs that are outside of kind of the traditional that we may have, other credit unions may have, where they allow 100% financing with a certain credit score and other things like that.
But just to be aware, if you are asked for a down payment, all that is a little chunk of change that you need to put towards the price of a home. And usually that percentage is based on the purchase price. So if you look at a really large home, very expensive home, that percentage is going to be a little higher. You also want to be aware of closing costs, which are loan cost and other cost. So loan costs are pretty straightforward. Those are the fees that the lender has to charge in order to complete the mortgage loan. But the other costs, which include escrow, can be, it's kind of a catch-all. It can include hazard insurance, realtor compliance fees, escrow, account establishment, prepaid interest on your mortgage, and tax preparations. So here's an example of somebody who's going to buy a home. And Ken, do you mind guiding us through this example?
So this is a example that has a purchase price of about $294,000 with 3.5% down. 3.5% down will typically tell you that it's an FHA loan. The loan costs are kind of that number there. We're not going to add that and the next line down that says other costs. That loan cost is kind of like an average of the next two items together. So your loan costs are typically the title company fees. The prepaids are going to be when you have to buy, when you buy a new home, you have to buy the first year's hazard insurance up front. I say up front, but that can be rolled into the loan. So the first year's hazard insurance, the title fees, your prepaid to your escrow account that covers the next year's insurance, as well as your property taxes that come up. Those are all lumped into this other costs and prepaids thing. And it completely varies. Like it widely varies based on the home itself and then the taxes on that home, as well as the insurance. So if you have really high property taxes on the home you're buying and really high homeowners insurance on that home, your other costs and prepaids are probably even going to be higher than what we've got on this piece of paper here. So that's kind of what I wanted to make sure you understand, is that those other costs are not necessarily things that have to do with your lender or the title company. They can actually have more to do with the home itself. So in this example, the person, $294,000 with 3.5% down is $10,290, and then their loan costs are about the same as their down payment, which is typically about what you'll see is the down payment, might be 3.5 or 5% down. The loan costs are typically between 3 to 5% also. So that's a good number to keep in your head, that if I'm going to be putting 3 to 5% down, that whatever that number is, because that's based off the sales price, you need to assume that probably that amount is going to be included for loan costs as well, and prepaids.
Okay. And do you feel like $294 is that kind of a median price that you're seeing come in here in Jacksonville?
$294. When we put this together with Member First, I asked them to do that because that right now I believe is the limit for the Jacksonville Head Start Homeownership Program. So we wanted to use that just because that's their limit for right now for a home purchase. Jacksonville homes, the median home price has gotten up to closer to 400,000. But we think and hope that prices will be coming down some next year, along with rates. Everybody's keeping their hands and fingers and toes and everything else crossed that things will start to go down a little bit. One thing I will tell you is that we think they are, and some other things that I've heard will indicate that they will be hopefully soon. We're going to talk soon about renting versus owning, and I will tell you that my wife is a property manager for an apartment complex, and she's already told me that they're telling them that they expect rental rates to be coming down next year. Well, they only do that in concert with home prices and interest rates, because as long as they can charge a higher rent rate, they're going to charge a higher rent rate. So they expect that, because you can't keep charging higher rent if it's cheaper to own than rent. So they must expect that to be happening next year as well, because that's kind of what they're preparing for.
All right. Thank you so much. That is such valuable insight.
Sure.
You touched on that renting. Unfortunately, Florida is not a rent-controlled state. There are arguments if that's good or bad for the economy, but either way, it's not rent-controlled, so rent can always change. So let's go through some different benefits, some pros and cons, if you will, about renting and owning. So if you have home of your own, then you can build wealth. You have a good long-term investment. This statistic right here shows that the Federal Reserve of St. Louis reported that the average price of homes sold in the U.S. rose 28% in 2 years, starting in 2009. I will say from personal experience, my husband was just lucky enough to buy a home here on the river in 2020. It has almost tripled in value. So you definitely are able to build that equity, which is the second point we have here. The equity, when I say equity, that's just the difference in between what you can sell it for and what you still owe. So your equity grows as you pay down your mortgage. When you're making your first payments, those are kind of more so going towards interest. But as time goes on, you own more of your house than you owe, if that makes sense. That's going to be your equity. Whereas with renting, you're going to make a rental payment each month, but that money just goes to the landlord or leasing company. You're not contributing to your own wealth, you're contributing to the wealth of the community. So it's a little bit different. There's also certain stability. So with a mortgage, like I said before, there's no rent control in Florida. Most states in the US don't have it. So with homeownership, you can have a fixed rate mortgage payment. And so every single month, you're going to pay the same amount for principal and interest until the mortgage is paid off. Rent can increase at every annual lease renewal. So we want to just keep that in the back of our minds. And then, of course, you can start planning your roots with your own home. You're able to get involved in your community, create a comforting environment, and start raising your own family. With renting, with today's market, you can have a higher payment than a mortgage right now, which sounds crazy, but I see it all the time. The average rent that I see come across my desk for my financial counseling is in the $1,200 to $1,500 range for a family. And that's not like a super nice place or even a house. A lot of times that's a 2-bedroom, and sometimes it's not even a 2-bedroom. So just knowing that could be going towards a mortgage is something to keep in your mind. And like I said, rent can increase. There's also certain tax benefits, federal tax benefits to having mortgage interest. That's a deductible on your property taxes and closing costs when you buy the home. And also, as a renter, you're not going to get those benefits. So there's lots of benefits that we're seeing here with homeownership. And then my personal favorite, I am a homemaker type lady. So you're able to redecorate, you can remodel, you can make plans with your family of what you want the house to be. And then part of the fun of that is thinking that if you do sell your property one day, you've put that money in and you could get a return on your investment, especially if you do it strategically and choose to do things that you know will hold investment over time, like adding on a porch or just making your yard look really nice. With renting, you're not going to be able to make as many cosmetic improvements. Sometimes your rental home is going to be a little bit outdated because that's just an investment property for the owner. And you're not able to make those big changes. You're definitely not going to have any equity when you sell it because you can't sell it. It's not yours. Some other mindful matters to consider is going to be the upfront cost. So many mortgage programs require some kind of equity injection, which is just another way to say upfront cost, which could include a down payment, the escrow funding, and items paid in advance as prepaids, like Ken was telling us about. There could be maintenance costs on your home. There's always going to be maintenance costs on your home. That's plumbing, electrical, air conditioner. It's no sweat to fix those things. You can always call and find somebody to fix those things, but you need to be aware that before you become a homeowner, you have to have a budget for that. You also want to be mindful of property values. The property value of your home can rise over time, but it can also fall. I know from 2006 to 2009, we definitely saw that here in the US when we had a little bit of a meltdown. Also, equity does not grow immediately. Like I kind of touched on earlier, your monthly payment goes towards interest in the early years of a mortgage. You got to just keep paying that mortgage, and eventually you'll gain equity. It will go quickly if property values skyrocket like they have here. But if property values kind of dip again, it's not really what I'm trying to say is everything's kind of like an ebb and flow. So one last thing is liquidity. Although homes have value, they don't sell as quick as stocks or other assets. So if you're going in trying to buy a home as an investment property or something like that in the future, just be aware that flipping a home isn't always just super fast. All right. I want to check the chat real quick. Does anybody have any questions? Beverly said, are HOA fees included in the other costs for your closing costs, Ken?
No. Your HOA fees are always paid outside of your escrow account. So if they're monthly, you might have to write a check every month, or they send you a statement to pay them where you have a little thing to tear off and mail in every month. Sometimes they're quarterly, mine are annually. So I only pay them once a year with mine. But I also have a property that has CDD fees, which are even worse than HOA fees. But HOA fees are not included in your monthly payment. Now, I will say this one, let me add one thing. When you go to qualify, though, your HOA fees are used as part of the monthly payment to make you qualify. So if you go out, find a condo that has $450 a month HOA fees, it takes away from how much condo you can buy, because that's now coming away from your monthly payment. I think I saw Frank say, what are CDD fees? Those are community development district fees. So what that is like the neighborhood I live in has about 1,200 homes, and they did not use county dollars, I guess, to build the roads through there. So they later passed that on to the homeowners in the form of a bond, is how I was explained. Anyway, they basically get added to your property taxes. So they do get included in your payment, because they're part of your property taxes. If I go to the county website and look at my property taxes, there are property taxes, and then under it has my CDD fees, but they get lumped together as one bill every year. So my escrow company pays that, whereas my HOA, when I mentioned that, and we were talking about that earlier, mine personally is only $110 a year because we've got such high CDD fees. So that's, I only have to pay that once a year with that small amount versus that CDD that gets split up into 12 payments and gets included in my payment. So.
All right. So let's go forward and talk about just a few more basic concepts. So we're going to go through the mortgage process as a whole. When you start seeking out a mortgage, you're going to start with a pre-qualification, then your application, then processing, underwriting, closing, all the way to move-in. Pre-qualification is just exactly what it sounds like, finding out what you qualify for so you can start shopping. So there's going to be a review of your credit, a review of your income, a review of your assets, and that's when you can set that budget. Then you're going to go ahead and apply. There might be some updates to the information that you first gave your mortgage processor. Maybe your financial status has changed. Maybe you forgot, oh, I also do have some additional income that's coming in every month that I can count on. There will be a receipt of the purchase agreement and sales contract. There'll be a home inspection, which is not required by the lender typically. However, it's really highly encouraged. You don't want to go into a house and not have a home inspection and then find something really bad like asbestos or a major plumbing issue or electric issue down the road and not be aware of it. Or a roof issue. I just had neighbors across the way. They bought the house, and before they even moved in, they had to replace the entire roof. There was major leakage apparently. So also, there's going to be the issuance of the loan estimate, which is going to be the estimate of the financial transaction. Then there's going to be the processing side. This is where Ken and our friends at Member First Mortgage are working together. There's going to be an assignment of the processor who's going to work directly with you. That'd be Ken if you're working here at Alive. And they're going to collect some financial documents, anything extra that they need. Ken, I believe you have a full packet ready to go so everybody knows what they need right out the gate so they can have everything gathered together for that. And then there's going to be a third-party verification. That's going to happen in the background. You're not going to have any part of that, but there's going to be an appraisal. There's going to be that title work. There's going to be employment verification. That's all the processing side. So you kind of take a back seat then, and then you're still in the back seat during the underwriting. It's completely out of your control. They're going to review your application, your credit, all the documentation that you sent in, make sure you meet all the requirements for the investor on your loan. After that review, there could be some additional documents. So they may come back to you for just a few more documents in order to solidify that loan request. And they're going to always communicate through whoever you've been working with. So that'd probably be Ken or somebody at Member First. And then finally, you'll wait, and you'll take a deep breath because you'll reach closing. So once underwriting has issued the clear to close, a closing appointment will be set by your realtor with a date, time, and location. Your realtor will coordinate a walkthrough and final review of the home. And then they're going to issue a closing disclosure, which details the final numbers, the final payment amount, the final loan package all together. You're going to sign those mortgage documents and you get the keys. And then guess what? Call up your friends or the movers or that buddy who owes you and order some pizza because you're ready to move in.
By the way, it's only about 30 days. Typically, you're from start to finish. Once you've found the house and put in your contract and get the loan application submitted, it's about a 30-day process.
That's quick. That's really quick because you hear these nightmare stories, but 30 days is easily doable. All right, so what's included in your mortgage payment? Sometimes you're looking at that mortgage and you're like, where did they get this number from? This is where they get the number from. There's the principal, interest, taxes, and insurance, PITI. The principal amount is the portion of your payment that's going directly to the balance of the house, that exact amount of the house that you borrowed. Then there's interest, like on every loan, and that portion of your payment is going to go to the cost of borrowing. Then you're going to have a portion of your payment that covers the property taxes, either to your city or county. I saw our friend Morag is joining us today, so I'm not sure how it works over there, but over here we'd have to pay to our city or county. Then you're going to have insurance, so that's going to be PMI, private mortgage insurance, homeowners, and or flood. I know I have to have flood. I think probably everybody in Florida has to have flood. So PMI is required on mortgage loans when the buyer applies less than 20% down. Homeowners insurance or hazard insurance, that's going to protect your home from the hurricanes, from fires. And then flood insurance is separate from hazard insurance, and it's strictly going to protect your home from flooding or high water. It is required by law in some areas. Oh, whoops. All right, so borrow eligibility. There's 3 things that you need to know before you contact Ken, before you start that pre-qualification, just so you're ready and squared away. We already talked about you're going to be aware of your credit, but for qualification purposes, you want to know the A, B, C's of qualifying for a mortgage. A, assets, the more the better. If you have 3 to 5% of a down payment ready to go, that's great. Knowing that your less risk is going to be that credit part, and just being able to make consistent payments. That's really the secret. There is no secret to credit. The truth is just making those payments every single month on time, not carrying high balances, you're going to be okay. B is going to be borrower income. We want to see that you're able to repay your mortgage loan, right? Anybody you give money to, you want to know that they're going to be able to pay you back. So you want to seek to have a debt to income ratio of 33 to 38%. You don't want to be over that percentage amount. And really, if you can, lower than that's even better. You have to borrow something to have credit, but you don't want to be over borrowing, if that makes sense. Lenders may use some terms with you, like top ratio and bottom ratio. Top is going to be the total housing payment divided by your gross income, and bottom is going to be total housing payment plus any debt, then divided by your gross income. Then C is credit, of course, that's the center of this all. So understanding your current financial situation, your credit score, paying your bills, avoiding judgments and collections, monitoring those credit bureaus, making sure there's nothing fishy out there. Remember, you can always freeze your credit for free and then just unfreeze it when you're ready to apply for things. And then just strive to keep your credit score at or above 680. That way you're able to receive the most favorable credit financing. I'm not saying it's impossible under that, but that way you're able to get favorable credit financing. Next, of course, is employment. Borrowers have to have at least 2 years of documented stability, ability, and dependability of income. That's a lot of itties. Self-employed borrowers need to expect to provide at least 2 years of complete federal tax returns for yourself and every business that you own. So having those documents ready, knowing that you need to be aware of those situations ahead of time. And then exceptions. Previous bankruptcies and foreclosures can be allowed with certain stipulations. Make sure that you know that as soon as you apply for any credit, they will see that. There's no hiding it. So they'll probably ask you some questions. Again, don't feel like you cannot apply. Just know that you want to be aware of your situation, have those facts in order. So that being said, Ken, do you mind running us through our first time home buyer program here on Alive?
Yeah, so we work with the Duval County Head Start to Homeownership. They have a program right now where you can get up to $50,000 for down payment assistance. That $50,000 is dependent on your number of people in your household, your income, things like that. But it's a good program. It will help you get into a home. It's a little bit more to go through as far as a process for you as the borrower, because you are basically qualifying for 2 loans. The second one is a loan with no payment that is forgiven after 15 years. But the other part of that, I will tell you, is that they try to make sure that you are truly qualified for that loan. And so what I mean about that is they do not want people that make more than they say they make, to apply because they will find out eventually and you won't get the loan. So they're very, it will seem like you're almost trying to fight through the process with them. It's just because they don't want to give that money to anybody that doesn't deserve it. And they have a lot of instances of where they find out that somebody makes more than they said they make. So this is an issue that they just have to fight through, and they deal with it on a regular basis. So you have to realize that that's part of their job when you go through this program, and it's just how it is. But it is a good program. We have put several people in homes through this program that otherwise could not have purchased a home. So it really is a good program, and different counties have them. Unfortunately, Duval, Nassau, and Clay, I think, might be the only three that are our local counties. St. John's does not have one, nor does I can't remember the other one. Nassau, Clay, and Duval have them. It's two more that don't. I can't remember, but for sure St. John's doesn't. But we try to work with all of them, but specifically we are signed up as a lender for the Head Start to Homeownership with Duval County.
And Beverly over in the chat asked, Ken, is this process any different when you're buying a home that is foreclosed upon or in foreclosure?
Yes, that's a great question, because they want to make sure that they are not putting someone that they consider moderate or lower income into a home that is going to cause them a bunch of repair issues. So the city has their own inspector that goes out and has to pass this home. So to say, and I won't say you can't buy a foreclosure, because there could be a foreclosure that's in great condition. But if you're looking for foreclosure that has, oh, I'm going to go in and fix it up, that is not the thing that they want you to do, because they don't want you to move into a home and then not be able to afford it because of all the repairs that you're trying to make. So that's their main goal, is they're just trying to protect you from getting into something that you really don't want to be into as a first-time home buyer. So that you can buy a foreclosure, but just know their city inspector is serious. Like, he checks the electrical outlets, he checks every single thing in that house. And if they don't pass, the home seller has to repair them. And a lot of times, if you've got a foreclosure or a place that they're trying to sell as is, the seller doesn't want to fix it. So that's where you might run into problems looking at a fixer-upper or a foreclosure with their program.
Okay, so not impossible, but a few more hoops to jump
Right.
through, going to slow that process.
Yep.
Now, here at Alive, we do have a couple of other loan programs that we can go into here. We have conventional loans, FHA, VA, RD, construction, and more. Oh, I just clicked the wrong thing here.
I will add, since we were talking about H2H, most of the H2H loans we do are FHA. FHA allows that second to be inflated over 105% combined loan to value. And sometimes with that being $50,000, if you're using $50,000 and add it to, if it's a lower priced home, say maybe under 200, then the combined loan to value ends up being over 105%, and you have to use an FHA loan. So we typically do a lot of FHA loans with the H2H.
Okay. All right. And I do see that that's a little bit more tolerant of past credit blemishes, and you can take gifted funds from immediate family.
Yes.
Awesome.
The other thing with FHA versus conventional, and this, I tell a lot of borrowers this right when they apply, depending on their credit score, or if they know what their credit score is. If you are under 680, I'm almost always going to suggest that you do an FHA loan, even if it's not an H2H, because conventional loans, they price their PMI based on your credit. So the lower your credit score, the higher the cost of the private mortgage insurance on your home. FHA pretty much gives everybody the same rate. So if you're under 680 and you want to have a lower payment, obviously, who doesn't? We typically look at FHA because of the fact that their PMI, if you're not, putting only 5% down or 10% down, or as little as 3.5%, their PMI cost to the borrower and their monthly payment is going to be less.
Awesome. We also do conventional loans, of course, right? So 10, 15, 20, 30-year fixed rate or ARMs. That's going to be a little bit more stringent. Second homes can have as little as a 10% down payment, I believe. And then we also do VA loans. So this is a great benefit if you're a veteran who has served our country. We are deeply appreciative of your service. And VA loans are a little bit different because there's no private mortgage insurance, right? And 0% down payment. Is that true here in Florida? Because I do see that member first said there's some state limits there.
I have never had any issues with the 0% down for a VA, and the no
Awesome.
PMI is correct as well. And I saw Beverly ask about, do all lenders require PMI? If it's an FHA or a conventional loan, yes, it will have to have PMI. If it's a loan like we have got a product here in house that we were offering for 100% financing, you had to have a certain credit score, things like that, and it wouldn't have PMI. But typically, if you don't have PMI on the loan, you typically pay a little bit higher interest rate, which, you know, if as the loan ages, the interest is going to go down as far as how much you're paying each month anyway. So there's good and bad depending on what your goal is and how long you think you're going to be in the house, which one is better for you as far as a loan with no PMI or a loan with PMI. The other thing about PMI is if you've been in your home for 2 years and the value skyrockets and you now own less than 75%, you can get out of the PMI as long as you've been in the home for two years. You just have to have a real estate agent come out. They give a quick price opinion on the home and give it back to the lender. And as long as they say it's above the value it needs to be, then they take your PMI off of your loan.
And that's a perfect segue, Ken. I did want to touch really quickly on the realtor's role in all this. That real estate agent is kind of the middleman, the broker between the two parties, both the person who wants to buy, which we hope is you, and then the person who's trying to sell and make a profit on that property. So real estate agents, they are going to know the local laws on buying and selling of property. They're going to know the trends on the local market, competitive prices. They're going to be able to maybe even match something that's going to work for you and your budget. But you have to keep in mind that negotiation is part of a real estate agent's work and how they make money. So just be aware that you need to go back and forth and kind of play the cat and mouse game to make sure that you're being protected, you're getting the correct house that you want, the house that you can afford, and just being aware that you do want to have a really good realtor that you're working with that you trust. Ken, I did not ask this ahead of time, so I'm going to be putting you on the spot here. But if somebody were interested and they came to you, do you have anybody that you can recommend as far as realtors?
Yeah, I have a couple that I refer people to every once in a while for sure. Yeah.
Okay. So also you're going to find when you're looking for housing, buying agents versus listing agents, a buyer's agent is contractually bound to help the clients realize the best possible price and terms when purchasing. Okay. The buyer's agent, they're responsible for viewing properties, evaluating neighborhoods, offering expert advice. The listing agent is hired by the owner, the seller of the property, and that agent is going to work to establish an appropriate sale price. They're going to look at the market. They're going to look at several comps to see what the pricing should be, and they're going to try to get that top price. In any real estate office, every agent works hard to sell the properties, and each is paid only if the home is sold. Their commission is their paycheck. All right, so I feel like we got through that pretty quickly. I do have Ken's information here. I also have Jim Dymek from Member First Mortgage, who is our contact here for this presentation today. And him and his team put together this beautiful presentation. So I would say first port of contact would be Ken if you have any questions about any of the loan products here at Alive. And Jim, if you have any further questions on Member First Mortgage.
And I'll add real quick, we chose Member First Mortgage as a lending partner because they are a credit union based organization. You heard that at the beginning. So the fact that they work with mostly credit unions, I think they might have a few small community banks that they deal with, but mostly credit unions is what they do business with. So that makes us realize that they're like-minded. and that they're out to protect the member, that they're trying to do what's best for the member and not just make a dollar. So that's why we have a relationship with them, and we've been with them for a little over 3 years now. So it's been a great relationship.
Well, thank you everyone again so much for joining us today. I will stay on and Ken will hang back for just a moment longer to answer any questions in the chat. If you're watching the replay, thank you for joining us. Feel free to reach out to Ken at Alive with that information on the previous screen, and stay up to date with all the happenings here at Alive by following all of our social media, Facebook, Instagram, YouTube. Look there, you'll find us. We have lots of fun events, and we have free financial wellness webinars every single month, second Wednesday of the month at 1 p.m. I hope you have a wonderful holiday season, Merry Christmas, and Happy New Year to you and your families.
Thank you.